So, you want to get into intraday trading, huh? It's this wild world where you buy and sell stocks, or forex, or even crypto, all within the same day. The goal is simple. You get in, you get out, and you hopefully pocket a little bit of profit before the market closes. Sounds easy, right? Well, not so fast. A lot of people jump in thinking it's a get-rich-quick scheme, and let me tell you, that's the fastest way to lose your money. The reality is, it's a high-stakes game that requires skill, a solid strategy, and nerves of steel. Now, before you click away thinking this is all doom and gloom, let me be clear. It is possible to be successful at this, but it's not about luck, it's about being prepared. You wouldn't try to build a house without a blueprint, and you shouldn't start trading without understanding the fundamentals. That's exactly what we're going to do in this video. I'm going to break down everything you absolutely need to know from the ground up, so you can start your journey with your eyes wide open and a much better chance of success. We're going to cover what intraday trading actually is, the core concepts you have to master, the tools that professional traders use every single day, and some of the most popular strategies out there. I'll also be completely transparent about the risks, because trust me, there are plenty, and give you some practical, no-nonsense tips to help you avoid the common mistakes that trip up almost every beginner. So, if you're serious about this, make sure you smash the like button for the YouTube algorithm, and let's get right into it. Alright, let's start with the absolute basics. What exactly are we talking about when we say intraday trading? In the simplest terms, it means you are opening a position and closing that exact same position on the same trading day. You are not holding anything overnight. The market opens, you do your thing, and by the time that closing bell rings, you are all cash. You're flat. Your goal isn't to invest in a company for the long haul, hoping it grows over years. Nope. Your goal is to capitalize on the small, tiny price fluctuations that happen minute by minute, or even second by second. It's all about short-term volatility. You might be thinking, can you really make money off a stock that moves just a few cents or $1? And the answer is yes, because intraday traders often trade with larger position sizes to make those small price movements meaningful. A 50-cent move on 10 shares is just $5, not very exciting. But a 50-cent move on 1,000 shares, that's $500. Now we're talking. This type of trading isn't limited to just stocks, by the way. It's incredibly common in the forex market, where you trade currency pairs and also with commodities like gold and oil. Basically, if it's a market with enough movement and enough people trading it, you can bet there are day traders in there. The key thing to understand is that this is a completely different mindset from long-term investing. An investor might look at a company's financial reports, its management team, its future growth potential. A day trader? They're looking at charts, patterns, and the immediate supply and demand in the market. They care about what the price is going to do in the next 5 minutes, not the next 5 years. It's a high-speed, high-focus discipline that's all about capturing small profits repeatedly. It's a job, not a passive investment. And like any job, you need the right training to do it well. Okay, now that we know what it is, let's talk about the concepts you have to get right. First up is timing. With intraday trading, timing isn't just important, it's literally everything. The difference between a profitable trade and a losing trade can be a matter of seconds. Your entry is the price at which you buy, and your exit is the price at which you sell. Nailing these is the entire game. You're trying to buy at a low point and sell at a high point within a very short time frame, or vice versa if you're short selling. This requires a deep understanding of market momentum and being able to make decisions quickly and without hesitation. Hesitate for even a minute, and your perfect entry point could be long gone. Next, let's talk about 2 words you'll hear all the time: volatility and liquidity. Volatility is basically the measure of how much a stock's price is bouncing around. For a day trader, volatility is your friend. A stock that doesn't move is useless to you. You need those price swings to create profit opportunities. Liquidity, on the other hand, refers to how easily you can buy or sell a stock without affecting its price. High liquidity is crucial. It means there are tons of buyers and sellers at any given moment, so you can get in and out of your trades instantly at a good price. Trading a low liquidity stock is a nightmare. You might get stuck in a position, unable to sell when you want to. And now for the most dangerous and tempting tool in the toolbox: leverage. Leverage is essentially borrowing money from your broker to trade with a larger position size than your own capital would allow. For example, with 4-to-1 leverage, you could control $40,000 worth of stock with just $10,000 of your own money. This can be incredible because it magnifies your profits. That small price move we talked about earlier now makes you 4 times the money. Sounds amazing, right? But here's the catch, and please listen carefully. It also magnifies your losses by the exact same amount. Leverage is a double-edged sword that can build your account fast, but it can wipe you out even faster if a trade goes against you. So how do traders actually time their entries and exits? They don't just guess. They use a method called technical analysis, which is all about analyzing charts and using statistical indicators to predict future price movements. The foundation of this is the candlestick chart. Each candle gives you 4 key pieces of information for a specific time period: the opening price, the closing price, the high, and the low. By learning to read candlestick patterns, formations like dojis, hammers, or engulfing patterns, you can get clues about whether the market sentiment is bullish, meaning buyers are in control, or bearish, meaning sellers are in control. It's like learning to read the market's body language. On top of the patterns, traders draw lines on their charts to identify key levels. The 2 most important are support and resistance. Support is a price level where a stock tends to stop falling because buyers step in. Think of it as a floor. Resistance is the opposite. It's a price level where a stock tends to stop rising as sellers take over. Think of it as a ceiling. Traders watch these levels like a hawk. They might buy when a stock bounces off a support level, or sell when it gets rejected at a resistance level. If a stock breaks through one of these levels, it can signal a major move is about to happen, creating a huge trading opportunity. But wait, there's more. To get an even clearer picture, traders overlay various indicators onto their charts. You've probably heard of some of these. Moving averages, for example, smooth out price data to show you the underlying trend. The RSI, or Relative Strength Index, helps you see if a stock is overbought or oversold. The MACD helps identify changes in momentum. Bollinger Bands show you volatility. And the VWAP, or Volume Weighted Average Price, is a favorite among day traders because it shows the true average price based on both price and volume. You don't need to use all of them, but finding a few that work for your strategy is absolutely essential. Alright, you've got the tools. Now you need a plan. A strategy is your rulebook for how you're going to trade. Let's cover 4 of the most popular ones. First up is momentum trading. This is probably what most people think of when they imagine day trading. The idea is to find a stock that's already making a big move, either up or down, on high volume, and just jump on for the ride. You're not trying to predict a reversal. You're betting that the current trend will continue for a little while longer. You ride the wave of momentum, take your profit, and get out before it turns around. This requires quick execution and a good scanner to find these moving stocks in the first place. Next, we have scalping. If momentum trading is riding a wave, scalping is like scooping up tiny drops of water. Scalpers are the most active traders of all, making dozens or even hundreds of trades a day. They aim to make very small profits on each trade. We're talking just a few cents. The goal is to let all these tiny wins add up to a decent profit by the end of the day. This strategy requires intense focus, very low transaction costs, and the discipline to take your small profit immediately without getting greedy and hoping for a bigger move. It's a high-volume, high-stress game. Then there's reversal trading, also known as mean reversion or counter-trend trading. This is the opposite of momentum trading. Here, you're actively looking for a strong trend to lose steam and reverse. You're trying to predict the exact peak or bottom. For example, if a stock has been shooting up all morning and starts to show signs of weakness, like a bearish candlestick pattern near a resistance level, a reversal trader might short sell it, betting it's about to fall back down. This is a very difficult strategy for beginners because, as the saying goes, the trend is your friend and you are actively betting against it. Getting it wrong can lead to some very big losses. Finally, we have range trading. This strategy works best in markets that aren't strongly trending in one direction but are instead bouncing between 2 clear prices. That support floor and resistance ceiling we talked about earlier. The strategy is beautifully simple. You buy at support and you sell at resistance. Then when the price falls back down, you buy at support again. You can do this over and over as long as the stock stays in the range. The danger, of course, is that the stock will eventually break out of the range, either to the upside or the downside, so you need to have a plan for when that happens. Okay, we've talked about the exciting stuff, but now we need to have a serious chat about the risks. I'm not going to sugarcoat this. Intraday trading is incredibly risky, and the vast majority of people who try it end up losing money. The number one reason is the misuse of leverage. As we discussed, leverage is a massive amplifier. A small mistake, a sudden market move against you, can result in catastrophic losses that can wipe out your entire account in minutes. It's a powerful tool, but if you don't respect it, it will burn you, guaranteed. This isn't an opinion, it's a mathematical certainty. The second biggest killer of trading accounts is emotion. Fear and greed are your worst enemies. Greed makes you hold on to a winning trade for too long, hoping for more profit, only to watch it turn into a loser. Fear makes you cut a winning trade too early, leaving money on the table, or it causes you to panic sell at the worst possible time during a small dip. And then, there's revenge trading. After a loss, you jump right back into the market, angry, trying to make your money back. This almost always leads to even bigger losses. Successful trading is about executing a plan like a robot, not making emotional, impulsive decisions. Another major pitfall is overtrading. This can happen for a couple of reasons. Maybe your strategy isn't working, so you just start taking random trades out of boredom or frustration. Or maybe you're scalping, and the transaction costs are eating you alive. Every trade you make has a cost, either in commissions or the bid-ask spread. If you're trading too frequently without a clear edge, you're just racking up costs and bleeding your account dry. And finally, you have to be aware of the impact of news. A surprise announcement, an economic data release, or even a political tweet can send the market into a frenzy, throwing all your technical analysis right out the window. It's a minefield out there. So after hearing all those risks, if you're still here and still want to do this, let's talk about how to do it smartly. My number one tip for every single beginner is to start with a demo account, a paper trading account. This lets you trade with fake money in the real market. It is the single best way to practice your strategy, learn the mechanics of your trading platform, and make all your beginner mistakes without losing a single real dollar. There is absolutely no reason to fund a live account until you have proven to yourself that you can be consistently profitable in a demo account for at least a few months. Period. When you do decide to go live, please start small. Don't dump your life savings into your trading account. Start with an amount of money that you are genuinely 100% okay with losing, because you might. This will help keep your emotions in check. It's much easier to stick to your plan when you're trading with $500 than when you're terrified of losing $10,000. Along with this, you must use a stop loss on every single trade. A stop loss is an automatic order that sells your position if it hits a certain price. It's your safety net. It defines your maximum risk on a trade and prevents one bad decision from blowing up your account. Finally, a few more crucial habits. Keep a trading journal. After every single trading day, write down what you traded, why you entered, why you exited, and what the result was. This is how you learn from your mistakes and identify what's working. Also, stick to your strategy. Don't jump from one strategy to another every time you have a losing day. Consistency is key. And lastly, as a beginner, it's probably wise to avoid trading during major news events or the first 30 minutes of the market open. These are the most volatile times, and they are where professionals prey on inexperienced traders. Wait for the market to calm down and show a clearer direction. So there you have it, a complete beginner's guide to the world of intraday trading. We've covered what it is, the core concepts of timing and leverage, the tools and strategies traders use, and most importantly, the massive risks involved. As you can see, this isn't a casual hobby you can just dip your toes into and expect to make a fortune. It's a serious high-performance skill that demands discipline, continuous education, and a huge amount of respect for the market. The potential for reward is definitely there, but it is directly proportional to the risk you're taking on. The path to becoming a consistently profitable trader is a marathon, not a sprint. It's paved with small wins, tough losses, and a ton of learning along the way. My hope with this video was to give you a realistic, no-hype foundation to build upon. Don't fall for the gurus online, promising you guaranteed profits. The only guarantee in trading is risk. Your job is to learn how to manage that risk better than anyone else. So, take your time. Start with a demo account, find a strategy that resonates with you, and practice relentlessly. If you do this right, if you are patient, disciplined, and treat it like a business, you can put the odds in your favor. But always trade responsibly. Never risk more than you can afford to lose, and never stop learning. If you got any value out of this video, I'd really appreciate it if you'd smash that like button and subscribe for more content just like this. Let me know down in the comments what you want to learn about next. Thanks for watching, and I'll see you in the next video.